1. Define corporate governance, particularly as it relates to fund management companies. 2. Describe why corporate governance is important. 3. Appreciate the importance of voting at meetings of shareholders. 4. Appreciate the need for investment performance presentation standards. 5. List the key elements likely to be included within performance presentation standards. 6. Define a composite and describe how composites may be constructed. 7. List some factors to be taken into account in calculating investment returns. 8. Recognize the need to properly present performance to clients and prospective clients and to have performance verified. One point one Definition: issues associated with business management practices and the structure of a company's board of directors. The Cadbury Committee defined. It is the system by which companies are directed and controlled, including the operation of a company involved in FM. What is particularly relevant to FMC is the role it can play in relation to the corporate governance of the companies in which it invests on behalf of its clients. From an investor's perspective, corporate governance relates to the degree of influence which should be exerted over companies by their shareholders, in the case of some institutional investors, if necessary, through their appointed FMC, with the objective of advancing their financial interests. Such influence is usually, but not always, through the exercise of voting rights or proxies at company meetings, particularly annual general meetings, and is directed at the way companies are governed rather than the way they are managed. Corporate governance, from an investor's perspective, involves the issues facing the board of directors of a company. For example, the interaction between the board and senior management, and the board's relationships with investors, owners, and others interested in the affairs of the company, such as corporate regulators, creditors, lenders, investment analysts, and auditors. Corporate governance also involves concerns over factors affecting corporate performance, which in turn affects investment returns to investors, such as strategy formulation and policy making. The rise of the institutional investor, FMC, have realized that the only avenue available to them in relation to an underperforming company is to encourage change through active involvement, i.e., voting, in issues raised at company meetings. Institutional investors may own a large proportion of a company's share capital, and who together may own the majority of the issued share capital of a company, cannot simply sell their investment through the market. Corporate governance, as an issue, is particularly relevant to the trustees of a pension fund advised by a FMC, represent the interests of the fund's members, employees and retirees, and have a fiduciary responsibility towards them. The trustee-appointed FMC, too, has a fiduciary responsibility toward its client and must, as part of its role, consider corporate governance issues in relation to the companies in which it invests, as well as having a keen interest in those aspects of the governance of companies which directly affect financial performance, and therefore investment returns to investors. FMC should also consider questions such as the accountability of management, and the equitable treatment of investors in terms of sharing the rewards between management and investors. In 1992 in the UK, the Cadbury Committee, Cadbury Code of Best Practice to disclose in their annual reports the extent of their compliance with the code and their reasons for non-compliance. In 1995, the Greenbury Report on Directors' Remuneration. In 1998, the Hampel Committee on Corporate Governance, Combined Code. In 2003, Higgs Review of the Role and Effectiveness of Director. These subsequently led to further revisions on the guidelines on corporate governance. In Australia, followed a similar route to that of the UK. The structure of corporate governance and the responsibilities of directors were considered in a booklet, Corporate Practices and Conduct. In 1995, the Australian Stock Exchange, ASX, introduced a listing rule that required all listed companies to comment in their annual report on their corporate governance practices. In March 2003, the ASX Corporate Governance Council, which was formed in August 2002, released its Principles of Good Corporate Governance and Best Practices recommendations. The guidelines require listed companies to adopt its recommendations, failing which, explanations would be required. In United States, institutional investors have played a significant role in encouraging good corporate governance. The California Public Employee Retirement System, CalPERS, has been noticeably successful in encouraging good corporate governance. In Malaysia, July 8, 2011, addressed in the Securities Commission, SC, Corporate Governance, Blueprint. A shift in corporate governance culture from mere compliance with rules to one that more fittingly captures the essence of good corporate governance, namely a deepening of the relationship of trust between companies and stakeholders. The blueprint focuses on 6 connected themes, namely shareholder rights, the roles of institutional investors, boards, gatekeepers and influencers, disclosure and transparency, as well as public and private enforcement. The Malaysian Code on Corporate Governance 2012, MCCG 2012, is the first deliverable of the blueprint and supersedes the Malaysian Code on Corporate Governance 2007. The MCCG sets out broad principles and specific recommendations on structures and processes which companies should adopt in making good corporate governance an integral part of their business dealings and culture. The MCCG 2012 focuses on clarifying the role of the board in providing leadership, enhancing board effectiveness through strengthening its composition and reinforcing its independence. It also encourages companies to put in place corporate policies that embody principles of good disclosure. Principles. The principles of MCCG 2012 encapsulate broad concepts underpinning good corporate governance that companies should apply when implementing the recommendations. Recommendations. The recommendations are standards that companies are expected to adopt as part of their governance structure and processes. Listed companies should explain in their annual reports how they have complied with the recommendations. As there is no one-size-fits-all approach to corporate governance, companies are allowed to determine the best approach to adopting the principles. Where there is non-observance of a recommendation, companies should explain the reasons. Commentaries. Each recommendation is followed by a commentary which seeks to assist companies in understanding the recommendation. It also provides some guidance to companies in implementing the recommendation. Although some of the commentaries provide examples and suggestions, these should not be taken to be exhaustive. While institutional investors have been involved in moves to establish guidelines on corporate governance for companies to follow, at the same time guidelines for institutional investors have also been established. In 1991 in the United States, the new Compact for Owners and Directors not only established several applicable to directors but also several applicable to shareholders. These principles were: institutional shareholders of public companies should see themselves as owners, not just investors. Shareholders should not be involved in the conduct of the company's day-to-day operations. Shareholders should evaluate the performance of the directors regularly. In evaluating the performance of directors, shareholders should be informed. Shareholders should recognize and respect that the only goal common to all shareholders is the ongoing prosperity of the company. In the UK, the Institutional Shareholders Committee has suggested that institutional investors should encourage regular, systematic contact at senior executive level to exchange views and information on strategy, performance, board membership and quality of management. Institutional investors should support boards by positive use of voting rights, unless they have good reasons for doing otherwise. Reason for voting against a motion should be made known to a board beforehand. Institutional investors should take positive interest in the composition of boards of directors. In all investment decision-making, institutional investors have a fiduciary responsibility to those on whose behalf they are investing, which must override other considerations. In Australia, the rights and obligations of shareholders set out in corporate practices and conduct had incorporated many of these suggestions but added that the responsibility shareholder increases with the size of shareholding. In relation to the composition board, shareholders should take positive interest where there are concentrations of decision-making power which are not formally constrained by checks and balances appropriate to the particular company. An appointment of a core of non-executive directors of appropriate caliber, experience and independence. Shareholders should take positive interest in the report and competence of auditors where appropriate. Be prepared to ask questions of the auditor. Shareholders should also take a positive interest in the appointment of a board's audit committee. In consideration of insider trading laws, shareholders should not seek to receive price-sensitive information which is not available to the market generally. In Malaysia, the role of institutional investors is discussed in Chapter 2 of the Blueprint. Background. Both the Capital Markets and Services Act 2007, CMSA, and the Securities Commission impose various client disclosure requirements on FMC. IMA between a FMC and a client will generally incorporate provisions relating to the reporting and disclosure obligations of the fund management company. Code of ethics or conduct, applicable to those working in the FM industry, may include requirements relating to the disclosure of clients of various matters that may affect the management of the funds. An important element of disclosure is that relating to the presentation of past investment performance, either for the purpose of reporting to a client the actual investment returns achieved by the FMC in respect of a single portfolio, or in relation to the presentation of the FMC's past performance for the purposes of attracting new client portfolios. Performance presentation standards are one aspect of a code of ethics or conduct that may be applied to a fund management company. To avoid misrepresenting to clients and prospective clients a fund management company's performance, it is important that investment performance be presented fairly. It is also important that all funds management companies present their investment performance in a similar manner, otherwise a client or prospective client could be misled in relation to the comparative investment performance of the fund management company. 3 key elements of performance presentation standards. Performance presentation standards, among others, would contain the following key elements. 3.1 The creation and maintenance of composites. It is clearly meaningless, and therefore misleading, to compare the investment performance of a Malaysian equities portfolio with that of an international equities portfolio. For this reason, performance presentation standards should include guidance on the formation of composites such as the aggregation of portfolios into a single group that is representative of a particular investment strategy, style or objective. The formation of a composite starts at the fund management company level. For example, all the client portfolios managed in the same manner are grouped to produce an asset-weighted composite return. The performance of the composite can then be more meaningfully compared with the return achieved by other fund management companies managing client portfolios in the same way. Once a fund management company has determined its criteria for composite construction, client portfolios can be assigned to particular composites. All portfolios must be assigned to avoid an accusation that the resulting asset-weighted composite return has been manipulated, perhaps by the exclusion of grossly underperforming portfolios, and is therefore misleading. An important factor in allocating a client portfolio to a composite is the discretion that the client allows the fund management company to have in managing that portfolio. Non-discretionary portfolios should not be included in discretionary portfolio composites since restrictions affect the fund management company's ability to implement its preferred investment strategy. Calculation of returns. In achieving compatibility, uniformity in the calculation of investment returns from a portfolio is clearly important. The generally accepted methodology in performance measurement is the time-weighted rate of return concept. It is not the intention of these notes to examine the basis of such calculations. However, such calculations generally take into account cash flows during the measurement period, the frequency of valuation, income accounting, the weighting of portfolios comprising a composite, treatment of expenses, including management fees, and taxation. 3.3 Presentation of results. Once determined, the investment returns of composite portfolios should be presented in a manner that helps meet the objective of fair representation and full disclosure. To present short-term performance in such a way that prospective clients are misled as to the capabilities of the fund management company is clearly unreasonable. The GIPS standard generally require a minimum of 5 years performance record that meets its standard, with additional annual performance up to 10 years thereafter. Annualized performances for periods of less than 1 year are not allowed. 3.4 Disclosures. The GIPS standard requires performance to clearly label returns gross of fees or net of fees and shall stipulate the complete list and description of the firm's composites. Details of currency used to express performance, the known inconsistencies and the exchange rates used among the portfolios within a composite, between the composite and benchmark must also be disclosed. Disclosure requirements also include consideration of the effect of leverage and derivatives used in the management of client portfolios. 3.5 Verification. Finally, the GIPS standards require that fund management companies' performance be independently verified and attested as such. Given the important decisions taken as a result of a consideration of a fund management company's performance, this does not appear unreasonable.